The vast economic power of China is increasingly under European scrutiny, with an undercurrent of assumption that Beijing will find it in its own interest to shore up the euro. China is projected to become the world's #1 economy within a few years. Its foreign exchange reserves are the world's biggest, valued at a level of some $3.2 trillion, and 1/4 of that is thought to be euros. China got that way by sustaining exports at very competitive prices. Many critics complain of frequent large-scale Chinese dumping or pricing below production cost. Low salaries in China count for a lot, as well as the value of the yuan currency. And this is another major irritation. Money watchers around the world feel that Beijing has kept the value of the yuan artificially low against the market variable dollar and euro. China's #1 trading partner and largest export market, the EU, sold more than 113 billion euros worth of goods to China last year, 38% more than in 2009. The EU in 2010 imported more than 280 billion euros in Chinese goods, which was almost a third more than the year before. A worsening of the European debt crisis would affect economic relations. The logic is one of supporting a #1 customer. From January to August of this year, it is estimated that China's exports to the EU have regressed by between 15 and 20%. Other grounds for China helping Europe's health are that EU companies' investments in billions of euros topped Chinese investment in Europe by 5-1 in 2010. Some see the euro crisis as an opportunity for China to boost its global soft power lead, as the size of its holdings is great, and the number of worthwhile investment targets is not infinite. A Chinese foreign ministry spokesman says, now, in the past or in the future, China will always be an important investor in the European financial market. There is unofficial talk that Beijing is using its offers of support for the Europeans to press its case for WTO market economy recognition with no more waiting.